Welcome back to Tech Tune Up. I'm your host, Paul Meeks. And of course, we're sponsored by my friends at Benzinga. And on this show, we talk about the trends and the companies impacting the tech sector, not just rehashing the news, but allowing you to come away from this presentation with some actionable trades. Some of them are longs and some of them are shorts. And over the last couple of episodes, we have been spot on in both directions. So let's get to it for the week. I'd like to highlight, and of course, I did intro this last show, DJT, which is your buddy Donald Trump's company. I will tell you this, as I did last week, and this has been a great short call because yesterday the stock dropped 25% in one day when it was revealed that in the entirety of 2023, this company only had $4 million in revenues and lost $58 million. I will tell you this, whether you're a conservative or a liberal, vote for the man or not on November 5th for president. But it's always been a bloodbath when you invest with him. I don't think that this company makes it. So be very wary. I continue to recommend short selling or maybe buying a put on DJT because I don't think it's a company at all. Next on the list is still my best idea in all of tech, and it has done particularly well as of late. Last week, I reported on its quarter, which was a barn burner to the upside. We made a nice call on that. But as they always do late, the Wall Street analysts came to the party after me last week and raised their price targets all over the street. And so I think Micron is now getting the love it deserves. And this stock, even though it's been explosive to the upside for us, is going to go much higher. Out of all the tech companies, still my single best idea. And yes, I would buy it today. Next, this is kind of interesting. MasterCard and Visa on the street. Sometimes they're covered by tech analysts like me. Sometimes they're covered by financial analysts, but this is significant. They have been forced to pay a $30 billion with a B fine to merchants to settle a suit over the gouging that they do when you swipe your credit card. Now, why is this news? A $30 billion fine can be absorbed by these guys pretty easily. But what happens if it forces a change in their business model? What happens if they get less of a take when you swipe at the store their credit card? It could really change things. And these stocks were so successful because essentially the oligopoly they had, that for years and years, they were perfect stocks to buy, hold, and go away, and you just absolutely crushed it. I think we have to rethink MasterCard and Visa. The next stock here plays right into my continued worry about cybersecurity. Here is AT&T. They announced over the weekend that the account data for 7.6 million current customers and 65.4 million former customers was swiped. And it may have not have been Russian hacker. It actually might have been an inside job. They're investigating it. But the problem is when somebody on the dark web gets your social security number, it can be game over. And unfortunately, in this case, lots and lots of social security numbers taken. Be very wary about cybersecurity. And as I do on the Meeks buy list, I try to invest in the worthy cybersecurity companies. Next, I think this is interesting on Amazon. Amazon is on my buy list, will continue to be on my buy list. And Amazon has kicked in $2.75 billion to support a company that has its own AI model called Anthropic. And this is after only a year ago, they already invested $1.25 billion in this private company. So what's happening is it's shaping up to be a battle royale. On one side, you have the team of Amazon and Anthropic. On the other side, you have the team of Microsoft and OpenAI. Microsoft owns 49% of OpenAI. And OpenAI got the AI party started when they released ChatGPT in November of 2022. Next, Reddit. Another good short call. I said, do not invest in this IPO. The business sucks. You cannot make money in social media unless you are either Alphabet or Meta. And after initial pop on the IPO, when all IPOs are geared by investment bankers to have an initial pop, if you ever have an IPO that doesn't have initial pop, wow, run to the hills. But anyway, since I made the short call a couple weeks ago, the stock has collapsed. And so this has been another very good short call for Team Benzinga. Next, Synopsys. Synopsys is a stock that's on my buy list. You may recall that this is not an obscure company. It's been around for a long time. But this is a company that is an EDA, electronic design automation software company. And their software is used by semiconductor engineers to design the latest chips. I've liked it for a long time. It's done very well for us. And just last week, they had an analyst meeting in which the management of the company substantially raised their financial guidance for the out years. So obviously, still a bull here. Next, let's get to Microsoft. Every week, we're going to be talking about Microsoft. But two items here. The first one I thought was super interesting. They are going to build with OpenAI. Remember, Microsoft owns 49% of OpenAI. They're going to spend $100 billion on a supercomputer called Stargate. And the interesting thing about this is, let's put this in perspective. In the second half of 23, the entire industry capacity for such computing power was 3,078 megawatts. And that was up about 50% from the same period a year ago. And that equals about 3 gigawatts. This new computer, Stargate, is going to have the capacity of hundreds of gigawatts. So the entire industry's capacity in the second half of 23 was 3 gigawatts. Now we're going to 100. You don't think NVIDIA and AMD are going to sell more AI GPUs? They're going to sell a ton. We're very early in this process, and I have never heard of such an expensive, elaborate, comprehensive AI infrastructure project. It is massive, and it tells you, obviously, where we're going. Of course, we've already known that theme here. The next thing is a negative for Microsoft. Microsoft has tried to bundle all their apps in their Office suite, right? That's how kind of they build, like what we always look for with tech companies, a walled garden, just like Apple has a walled garden of all of its internet connected devices. But this is interesting. The European Union, which unfortunately leads all the regulation of the internet, which is kind of sad. We don't even play a role. But they are forcing Microsoft to unbundle, to separate Teams and their Office suite. This is kind of interesting because, again, it plays into my theme that I've talked about for several weeks about how the regulators, not just here in the States, but abroad, particularly in the European Union, are really putting on regulations to disrupt and squeeze some of these tech titans' business models. So stay tuned. If there's any beneficiary, it probably would be Slack. And Slack is a Teams competitor. Slack is owned by Salesforce.com, ticker symbol CRM, and probably even our buddy at Zoom. Our buddies at Zoom should have some take up because now Microsoft can't compete in a bundle with its team offering. So we'll see, but it's kind of worrisome to me. In the meantime, I still own Microsoft for its AI push, its AI lead. Next, we have Coinbase. And Coinbase is very interesting because Coinbase has been a crypto exchange. And this is quite remarkable because the Securities and Exchange Commission has been after them for a long period of time. Why? Because they've accused the crypto exchanges of selling unregistered securities. Selling unregistered securities is nothing my firm can do or anybody else can do. And it looks like the lawsuit is going to go to the next level in the U.S. judicial system. And if we have a situation where the crypto exchanges have to go through all kinds of regulations, like the financial advisors do for all the other asset classes, it's going to put a dent on their models. So yes, crypto exchanges like Coinbase being forced to maybe register their securities that they sell, it is going to disrupt the crypto food chain. Stay tuned. Next, we have the Chinese company Huawei. Why do I talk about it? Well, remember, I've already told you on this show that the world is global, if you like it or not. And I have to follow, as a legit tech analyst and portfolio manager, the kings of technology wherever they are domiciled. And Huawei just posted a remarkable quarter. And this was a company that was under a lot of pressure in China because it had been blacklisted by the US for exports. And for them to come back, it doesn't look like we can keep this company down. This is very interesting to me. This is a comeback worth watching. This could change the competitive mix in global tech. Next, we're back to another one of those crypto exchanges, our old friends at FTX. Until a couple of years ago, this was the dominant crypto exchange run by the golden boy of crypto at one time, Sam Bankman-Fried. Now, Sam Bankman-Fried ended up being a shyster, and just to kind of close the loop on the story, he got 25 years in prison last week. His legal team thought he should only get 5 or 6 years in the slammer. The prosecutors were going for up to 110, and the judge settled on 25 years. Still a significant jail time for crypto fraud. Stay tuned. Next, Google. This is kind of interesting. This just broke this morning. Google has a feature, you've probably used it, on its Chrome browser called incognito mode, where if you click on incognito mode, you're supposed to be able to browse the net secretly. Well, what happened at the end of the day is you thought you were browsing secretly, and Google was looking at everything you did. Incognito mode was bullshit mode. So anyway, Google got outed, and they're lucky that they didn't have to pay a fine. There's going to be no monetary damages, but they are going to have to go back for several years and delete the browsing history of millions of customers that have been in incognito mode. And this is just another nasty PR for Google. And they are kind of screwing up everything left and right recently. All kinds of wounds of their own creation. And so even though I love Google's business model, it's one of the most profitable in the history of tech. It's not on my buy list right now, even though it's on everybody else's buy list, right? It's a member of the Magnificent Seven. They just keep on shooting themselves in the foot. It's kind of boneheaded. But anyway, more bad news for Google. Stay away. At some point, it will get cheap enough where I'll turn around and start recommending buying it aggressively. Just not yet. Now, next, here's my last stock, but I also want to take a deeper dive into it because it's super timely. So it's Tesla. Now, I subscribe to Benzinga like everybody else. And today, this is where I got the news. I'm supposed to be a tech pro. I get it from Benzinga's post called Ring the Bell. So Tesla announces today their most recent delivery and production numbers. Bottom line is they sucked. They were fairly dramatic declines from the same period last year and well below the street's expectations. And in recent weeks and months, the street had already lowered its expectations. Okay, so you could say that they had a low bar. So anyway, this has been another great call. This has been the worst stock, I believe, in the S&P 500 in the first quarter of 24. It's down another 6% today. I think that this price today at about $164 a share is super significant. The reason is, and take a look at the chart, is I believe that if we don't hold with Tesla and find reasonable support at the 160 to 165 level, which is where we are right now, we are going to break below the support that we found in March of 24, just about a month ago, and then also going back to the same level from the spring of 23. So that is pretty solid support, 160 to 165. If we break it, and we may break it today by the close at 4 p.m. Eastern, I think the next stop on this stock is 100. And if it goes from 160 to 100, even though the stock is already down a ton, that means it could drop another 40%. So despite the fact that we've been super successful, shorting a stock from $340 all the way down to 160, again, if we don't hold support here, I'm going to short more because I'm convinced it's going to go at that point, if that happens, from $160 a share down 40%, all the way to 100. And we've been there before. So why do I also, beat up on these guys? Well, the EV market is slowing down, and it's not just Tesla. We have the market slowing down considerably. In the meantime, that brings lower revenues to all, while expenses are rising. So revenue starts to decline or at least soften. In the meantime, your expenses are rising. These are fixed cost businesses. And so you're getting a margin squeeze. And at one time, Tesla had margins in their auto business that were much better than the legacy companies like a Toyota or a Ford or General Motors. The best performing global auto company, stock has soared, has been Toyota. Why? Because Toyota did not jump on the electric vehicle bandwagon. They focused on the sweet spot, what customers really want, which is hybrid vehicles, not all electric vehicles. So right now, Toyota has a better operating margin than Tesla. And so Tesla's operating margin or profitability lead has evaporated. In the meantime, Tesla still trades, even though it's down so much, at 41 times last year's earnings. And Toyota, which is 3 times the revenue size, has a pound for pound higher operating margin than Tesla, is trading at only 11 times. So that means if Tesla's multiple drops to Toyota's multiple, unfortunately, that stock can go down a hell of a lot more from here. So it also kind of bakes into my short case. The other thing that I've noticed, because I look up these stats, is when you take a look at the depreciation of automobiles, remember Elon Musk's promise at one point was that electric vehicles would not depreciate like regular automobiles. They would actually appreciate like fine wine or rare antiques. Bullshit. Unfortunately, right now, because prices are dropping so fast for new cars in the EV industry, including Tesla's models, they're now depreciating even faster than legacy cars. And that is a problem. I think I mentioned last week, I recently traveled to Florida to do a tech investing seminar, and I'm at the Fort Myers airport. And when I go to Thrifty Car Rental, they are trying to give away electric vehicles. They give them to you for the subcompact price, even though they're a 4-door sedan, because that's the only way the car rental companies get people to drive one. So that's a real bad sign. So it seems to me that Tesla's earnings per share are probably going to fall considerably, at least 30% year to year, the next couple of quarters. And here's a company that's shrinking rapidly, not growing. Part of the draw with Tesla was this autonomous driving. Elon Musk announced it with a lot of fanfare back in 2019. Well, here we are in 2024, still not really a thing, or still not really a thing commercially. And so, again, another kind of leg on the stool to support the stock kicked away. And of course, then there's Musk himself. He is unlike most CEOs or CFOs that will go to the public and hawk his stock. That's actually not such a bad thing, right? You want to have somebody give you a ray of sunshine when the company is down. But Musk will probably get on the next conference call, particularly after these horrid delivery and production numbers released today, and he won't support the stock. He'll probably just say, F you guys, if you don't like it, buy it. I mean, he says that all the time. So unfortunately, whereas some executives would be cheerleading their stock to kind of revamp that confidence on the street, he may actually add gas to this unfortunate fire. Of course, Tesla also has a huge problem in China. They're being beaten by a company called BYD. And it's really important for Tesla to succeed there because not only do they manufacture there, they count on customers there. And it looks like the issues they have, BYD and some of the other local companies are taking a lot of share from Tesla in their home market. And they have plans to start to sell their cars abroad, including in the US and in other Western markets in which Tesla competes. They're going to see some competition, serious competition from quality vehicles at a much lower price. What's that going to do to their sales? They've already kind of slumped some bit. The probably the key problem, that the auto industry experts will say is that Tesla does not have a mass market car, right? Their business model is to start with a luxury brand, lower its cost through efficient manufacturing over time to try to get it someday to $20,000, $25,000, $30,000, $35,000 a vehicle, which becomes mass market. You don't have a mass market car and you already have all of the luxury market for EVs in America. I don't know. I think you might be tapped out. And unfortunately, the last time that Tesla has revamped one of their sedans, has come out with a new model, was 2020. So you could say even mighty Tesla might be behind the innovation curve 4 years later. And the last thing I want to mention is, remember I told you that while revenues are coming down, less unit demand, prices are coming down as well, both of them very negative for revenues. We see that revenues and EPS at Tesla probably decline for the next couple of years. Here's another thing. Remember, I told you their expenses still might be rising. So one of the things that has been a big benefit to Tesla over time is it hasn't had to advertise, right? The word of mouth was fantastic. There were no other competitors. Kudos to them. But now they're getting more desperate to sell cars, to compete. And so they're starting to advertise. And when you advertise, wow, you put an advertisement at halftime on the Super Bowl, right? That's $7 million for 30 seconds. So if they're going to have to advertise for the first time, here comes another expense that's going to be ratcheted up. And that stuff is super expensive. So we'll see what happens. But I wanted you to, and I'll do this once in a while, take a deep dive in one of my picks. This just happened to be one of my short picks. So that's the stock section. Let's get to the buy list. I have a new addition today, but let's go through them. CrowdStrike and cybersecurity. I told you again with the AT&T news why cybersecurity is more important. This is my top pick. Next, I also mentioned Micron, the semiconductor company. The reason it is colored in green, still my best pick, even though it's been fabulous investment for the Benzinga watchers. T-Mobile and wireless. Microsoft, I've spoken about today. Right? We have this issue with the unbundling of Teams from Office. Don't think that's a big thing. I'm in it for its 49% stake in OpenAI. Meta, I prefer Meta to Google in digital advertising. Meta seems to execute, whereas Google just has one public relations faux pas after another. Talked about Amazon today, talked about Synopsys today. Believe it or not, even though it's been a heroic stock for us, still like NVIDIA. I think NVIDIA is still going up. Nice systems, IAC, been on the list for a while. Broadcom, ticker symbol AVGO, I like it. Mercado Libre is still on my list, though I only buy it with a $1,500 buy limit. Duolingo, we've talked about before, but my new addition this week is Dell, right? We have been fantastic with a company called Super Micro, SMCI, which makes specialized servers for data centers for AI applications, but the stock's too expensive. So that's why, even though fundamentally it's a titan, I've taken it off my buy list to kind of step aside for a while, let it come back in, then I'll re-recommend it. But in the meantime, let's go with Dell. Dell is also going to play a nice role in AI customized servers. And the other company in the space, which is HPE, Hewlett Packard Enterprise, is not as well run as Dell. So I'm going to go to Dell. AI servers is my theme, better than HP Enterprises, and a cheaper way to invest versus Supermicro SMCI, which has already been a big winner. You guys, that stock has been up, I think, in the last year, SMCI, 12-fold. Absolutely ridiculous. Let's get to my pans, right? They are red, get the hell out colored. I talked about Reddit. I talked about DJT. It is not a company. I think DJT is going to go to zero, if you like Trump or not. And then I've been through the bear case, which unfortunately is comprehensive. A lot of data points showing that Tesla will probably stay out of favor for some time. So I'm sticking with that case. Remember, if it doesn't hold 160, 165 today, I think that stock retraces all the way back to $100 per share. Now let's finish up with tech trends. Continue to watch interest rates because tech stocks and other aggressive growth stocks crave lower rates. And we are desperately waiting for the Federal Reserve Board, our central bank, to pivot from a higher rate regimen that they've been pursuing for the last 2 years to lower rates. But the problem is there's been some recent economic data on the inflation front and also on the employment front that shows that unfortunately inflation is pretty sticky high and the job market is tight. And if the job market is tight, then wages are forced up, which unfortunately also pushes up inflation. And remember, the Fed cannot lower rates until they have slain the inflation beast. And so last month, the core PCE, which is a best indicator for inflation, ignore all the other ones, it's called the personal consumption expenditures, were up 2.8% year to year, and the Fed's goal is 2% even. So you think 2.8 to 2.0 ain't much? You guys, 80 basis points, very tough to go from A to B. So stay tuned. You know, the greatest risk in this market is nothing to do with the fundamentals of any tech company. It has nothing to do with AI, or less to do than you might think with AI. It's all about when do we start to lower interest rates in this country. The next thing I think is very interesting. It's about the use in enterprises of generative AI. So Boston Consulting Group, you know, the big consultants, did a survey of the executives of companies. I think they actually spoke to 1,400 execs, and they're saying, you know, what are you doing with AI in your enterprises? Well, first of all, 60% of them, so the majority said, we're holding off on unveiling generative AI in our companies because we don't know where the regulations are going to come out. Isn't that interesting? So it's not a technology issue. They are frozen in their tracks because they're worried about their potential liability. So think about that. We're going to have to come up with a good regulatory plan for generative AI, or this thing might be stalled. Or if it's not stalled, at least it's not going to grow as fast as you think. And the other thing they said in the survey, because of their bearishness, because of their worry about AI regulations coming, only 6% of their employees right now are being trained on AI tools. So if they're only training 6% of their employees, do you expect AI to be like an explosion in the enterprise? No, it looks like we have some impediments here. So that's why I've always said, if you invest in AI, invest in the infrastructure builders, right? These are akin to not the AI gold miners, but the guys that are supplying them the shovels and the picks and the axes. Those guys will be okay as we continue to build these large language models. I don't know if you want to bet on companies that internally are rolling out AI in their enterprises. It looks like it's stalled. So this is kind of interesting. The chairman of Taiwan Semiconductor. Now, Taiwan Semiconductor is the most important semiconductor manufacturing company in the world, because the model in the United States is we design chips in Silicon Valley and then we send them to Taiwan Semiconductor to build them. But this is so interesting. It also tells you the power of AI, at least for the infrastructure builders like an NVIDIA. So the chairman of TSMC has said that they're going to have a GPU, that's the chip used for AI, and we're going to have in 10 years, 1 trillion transistors on that chip. You know what that is? Today, we might have a fraction of that, a very small fraction of that. And if this happens, the strong will get stronger because the manufacturing cost and preparedness to build these chips will be afforded by only a very few. In tech, because it's capital intensive, particularly if you manufacture semiconductors, the strong will get stronger. To, in 10 years, have a GPU with 1 trillion transistors on it? My God, that is a important move. The next thing is, I follow Micron. Remember, it's my top pick. We've seen a lot of traction with something called HBM, which is a high bandwidth memory chip. And this is going to be dominated by Micron in the United States, SK Hynix in South Korea, and Samsung in South Korea. Micron told us, and this is why I'm so bullish on it, that their orders for high bandwidth memory, which is a important component in these AI systems, is fully booked for all of 24 and fully booked for all of 25. So watch the trend in HBM, high bandwidth memory, because these AI systems have a voracious demand for it. And that's why, even though Micron has been such a successful investment for us, still sticking with it. Top idea, going much higher. I imagine that stock at some point at the peak of the next cycle goes all the way to $200 a share. And the last trend I want to share with you, this is kind of interesting. So we're in a tech bull market, right? That's been great for everybody that watch Tech Tune-Up. But for many years, we actually had, particularly as interest rates in this country were rising, we actually had a window closed for tech IPOs. The venture capitalists, the private equity tech investors just could not pry that window open to get their private companies public. And of course, they want to do that because that's how they cash out on their private investments. But I have seen some important IPOs come public. And this week, we've announced 2 more, a company called Luminance, another company called Rubrik. And it shows me that at long last, maybe no surprise, again, tech bull market, that the tech IPO market is opening. Of course, it's all driven by AI companies, but that is quite interesting because that had been closed for some time. This gives us more opportunities, some more, hopefully, great private companies going public. And of course, my job for you is when they come public, I poo-poo something like Reddit. But maybe when Luminance comes public, I actually support it because some will be pretenders and some will be stars. And I, in my portfolios at Harvest Portfolio Management for my Benzinga followers, that's my job, to differentiate between one and another. So you guys, it's been a good week. Thanks for tuning in, and we will see you next time.